Hi there. In this video, I want to cover 6 financial metrics that you should be measuring as a small business owner. In my last video, I covered why so many small businesses go out of business. And one of the big reasons was because of poor financial management, right? They run out of cash. And I talked about that that's a symptom of owners' inability or their lack of ability to manage the finances well. So if you're a small business owner and you don't have lack of kind of that business structure or clarity on what you should be doing to ensure good financial management, today I want to share 6 financial metrics that you should be measuring at the minimum. Right? There's a lot of other metrics that you should measure as a small business owner, but if you measure these 6, then I can almost certainly feel pretty confident that your business is going to grow in a sustainable manner rather than you eventually running out of cash and the business being shut down. So let's get into those 6 measurements. Number 1 measurement that you should be looking at is your revenue growth rate, right? That means what percentage is your revenue growing compared to the previous month, and how is that tracking over the months and over the years, right? Ideally, we want that number to steadily grow, and you should be tracking that, right? Because when we measure something, we make sure that it gets done, or that just gives you data to base your decisions off, right? If you see that the number is flatlining, then maybe there's some adjustments that you need to make, possibly, or you need to maybe do more marketing or do more sales effort. So that's going to be an important number to make sure that your business is growing. Right? And then the second number is your gross margin percentage, right? We want to make sure that we're increasing our revenue, but at the same time, we want to be mindful of what our gross margin percentage is. So what is gross margin percentage? That's essentially your revenue after you have subtracted the direct cost associated with generating that revenue. Right? So that's after you have minus your cost of goods sold, your direct labor, any material cost that went into it. So that's going to be your gross margin percentage. And as your business grows, you want to make sure that you have a solid gross margin, because that's going to make sure that you're able to cover your overhead well and you're able to pay yourself properly. And on top of that, after paying taxes or interest, everything else, you're going to have a net profit. So it's very important that we have a good gross margin percentage. And one of the ways to ensure that is by tracking it, right? So third financial metric that you want to look at if you're looking to grow your business is your CAC, your customer acquisition cost. So that's essentially your measurement for your cost of growth, right? That's your total marketing and sales expenses that it takes in a given period to bring in one new paying client, right? Or a customer. So that number is important because we don't want to spend so much money on marketing and sales to where that number is really high. And a good way to look at that number is in relation to the next financial metric, which is your customer lifetime value, your CLV. So that means how much revenue do you expect to generate from a specific client over the lifetime of that client. So those 2 numbers kind of go hand in hand. And we want to make sure that the ratio of CAC to CLV is at least 3 times. So that means if it costs you, $200 to bring in a new customer, you should expect to make at least $600 over the lifetime of that customer. So that gives you a pretty reliable gauge, that ratio of those 2 numbers, that your marketing is going to be profitable and you're growing in a sustainable manner, right? If your customer acquisition cost is so high that then how much revenue you generate from that customer, then if that ratio is too low, then if you keep growing, you're eventually going to be losing money, and that's not going to be a sustainable way to grow your business. So make sure that you're measuring that. And if you're not sure how to measure that, you can reach out to me. I can walk you through it, or talk to your accountant and figure that out, how you guys can look at that. So the 5th metric that you want to measure as a small business owner is going to be your net profit percentage, right? That's your ultimate bottom line. That means after all the bills are paid, after taxes are paid, after any interest is paid, how much money are you left over, right? What is that percentage? And we want to make sure that we're having net profit. Otherwise, you have just bought yourself a job. if you're not having any net profit. So a lot of times small business owners that I work with, that's more of like a guess for them, or they're not really sure what their net profit is. So if you're not tracking that, then how do you know that you can improve it, or if you're actually making true money off of your business? So please track that as a small business owner to make sure that you're able to grow that, and then your net profit is growing as your business is growing, right? You don't want revenue to grow so high just to, at the end of the day, just to be a lot busier but not have any more net profit. So please track that as well. So this, last but not least, is going to be your cash flow. As a small business, to ensure that you're able to grow successfully in a sustainable manner, you want to make sure you're tracking your cash flow. So in simple terms, what that means is how much cash came in each month versus how much went out, right? That's overall your revenue minus kind of all the expenses in more of an immediate manner, right? Your net profit gives you a percentage more of like on the long term, but your cash flow that's your true kind of operational profitability. That's going to make sure that you're able to cover all your overhead, you're able to pay yourself, pay your employees, and that you will have some kind of cushion. We ideally want to have positive cash flow, or we need to have positive cash flow if we want to grow our business. That will give you some, income to invest back into your business. So a lot of times, a business could be profitable, but if those profits are going to come down in the future, right, where that net profit is there, but if we're not getting some of the money as cash flow within each month, then we're ultimately not going to have enough to cover our expenses. So that's going to be very important as well for more of an immediate need. And then your net profit, that's going to be more for long term, that you're growing the business to where you continue to have net profit. So those are the 6 metrics that you should be measuring at least. There's going to be more metrics that we get into down the road. At a minimum, you should be measuring those 6 at least to ensure that your business is going to be profitable and you're going to stay in business as your business increases, rather than all of it just going to your overhead or your cost of goods sold. So I hope that helps. And if you have any questions, comment down below and I'll do my best to answer those. And take care.